Welcome everyone to Spring Cleaning Benefits Compliance 101. Thank you all so much for joining us. Our moderator for today's call is Yoko Yoon. She will be answering the questions you sent through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We'll be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'd like to introduce our speakers for today's call. Joining us today are Patrick Myers, Vice President and Counsel of Benefits Compliance at NFP, and Chase Cannon, Senior Vice President and Deputy Chief Compliance Officer of Benefits Compliance at NFP. Patrick, the floor is yours.
Thank you so much, Amber, and hello, everyone. Thank you for joining us today for our webinar. Today, we're going to be hitting the high points, high-level discussion of many of the statutes that govern benefits and benefits compliance. My name is Patrick Myers, and my co-presenter today will be Chase Cannon. Here's a slide with you can put faces to the voices. Now, as I mentioned, this is going to be a very high-level discussion, but I think I'd be thrown in lawyer jail if I didn't mention that this is only going to be for general guidance purposes only, and it is not intended to constitute tax or legal advice. The information that we're going to be presenting today is current as of today. We have a lot of ground to cover today, but I would like to start by providing with an overview of the federal laws that we'll be discussing today with an eye towards providing a general purpose for what we're trying to accomplish with these laws. When it comes to employees, these laws are designed to ensure benefits are received as they are promised by the employer or the employer's plan. They are designed to protect against discrimination and unfair treatment. They're also designed to reduce taxes, for instance, through pre-tax premium payments and contributions, as well as excluding those payments from gross income for employer and insurer payments. The laws are also designed to help employees understand what exactly they're getting out of these plans. Now, for employers, there are tax savings, both employment taxes as well as business deductions. And it also is designed to make it easier for employers to attract employees and retain them. And finally, it's the role of the broker and the service teams to help employers understand and comply with their obligations under these statutes. And Chase and I, as part of a compliance team, our job are to help the brokers and the service teams help the clients understand these obligations. And here's a list of the regulations that we will be covering today. As you can see, it's a pretty extensive list. We're going to be starting with cafeteria plans, then we'll go on through COBRA, ERISA, FMLA, ACA, HIPAA, Medicare. We're going to dive into non-discrimination a little bit. And then finally, we'll do a grab bag of other federal mandates that are commonly pop up in the benefits compliance space. But for now, let's start with cafeteria plans, and I will pass it over to Chase.
Thanks, Patrick, and thanks everybody for joining. It's great to be on the webinar, and always fun to be talking about compliance, and thanks for the overview too. It's always good to, when we're talking high level on these laws, the way I like to think about it is most of us are employees of a company, right? That's why we're on here. We have a job, we're working for somebody. And so in a lot of ways, it's helpful to think about yourself when you're thinking about these laws, meaning yourself as an employee. What in this law is protecting me? What protections are there? And then most of you on the call are on because there's some type of employer obligation that goes along with that. But I just try to think about it as me, like what am I getting out of this as an employee? And that helps kind of frame the overall purpose of these laws. And so we're going to start with Section 125. Or cafeteria plans. I'm going to go to the next slide, Patrick. But Section 125, and again, we kind of have two terms for this, right? Section 125 or cafeteria, where do those come from? The IRC, that's the Internal Revenue Code. Section 125 is the section that kind of bestows these tax benefits, tax advantages for certain situations. So from a tax perspective, we have to think of it as employees of our companies, everything that the company pays us or gives to us is taxable unless there's some IRC section that says it's not taxable. And that's kind of the general rule of taxation. Anything I'm getting, I need to pay taxes on, unless there's something that the IRS says that we don't have to pay taxes on. And one of those is found in here in section 125 that allows participants, that's employees, to select and enjoy benefits on a tax advantage basis. This is generally considered premium payment on a pre-tax basis and usually done through salary deduction, however you want to call that. And so you take the money out before taxes are applied and you send that money over to pay a premium. And this also applies to a health FSA or a dependent care FSA or a DCAP. Those contributions are coming through the Section 125 plan is what we call that. Sometimes these are referred to POP plans. That's a premium only payment plan, POP plan, or a premium only plan. And so you may hear that term. That is also a Section 125 plan. It's just a different name for it. So this is all good news for employees that want to take some of their money pre-tax and contribute towards premiums or contribute to a health FSA or dependent care. The strings are attached here, though, for what the employer has to do, and that's kind of what we focus on when we're talking about compliance requirements. What does the employer actually have to do? The first one is there needs to be a written plan document, and this one can be confusing because we're going to talk in a minute about ERISA. ERISA also has a written plan document requirement and an SPD or summary plan description requirement. This Section 125 written plan document is really meant to describe who's eligible to do these pre-tax contributions, meaning which employees. We know that certain employees or individuals are not eligible. Those include some of the owners and partners that are not considered employees. But the written plan document is really meant to describe who's eligible, which, what's the timing on the contributions, when does that occur? It should include this rule about irrevocable elections. That's the second bullet here, meaning you can't change your election throughout the year unless you have a qualifying life event. So we sometimes refer to that as a QLE or a Section 125 event. That is an exception saying, okay, well, in these certain instances, we're going to allow you to make an election change to your pre-tax contribution. So, for example, if I get married during the year, if I adopt a baby or have a baby, if I have a change in my status that might affect eligibility, that's what those Section 125 QLEs are. So that's another rule that the employer and the administrator need to follow when they're operating the plan. They can't just let people change their elections whenever they want. And those qualifying events should be outlined in the written plan document. The non-discrimination rules, we'll hit on this a little bit later as well, but this is this general idea that you can't favor highly compensated employees. And that can be especially challenging with if you're varying benefits at all. If you're saying, okay, we're going to class out these supervisors over here, these managers over here, we're going to give them a shorter, a better eligibility term. We're going to contribute more to their FSA or more towards their premiums than the others. And that's where we could get into some trouble with the non-discrimination rules. Highly comped for this purpose really relates back to a couple of buckets, but one is a more than 5% owner or shareholder, an officer of the company, or an employee that's making more than $135,000 for the year. So those that's kind of how you think of what is highly comped, and really that's the idea with the non-discrimination rules. We also have some special rules for the health FSA. The use or lose rule means if you don't use it by the end of the year, you sort of lose that money as an employee unless there's a carryover there or a grace period. Sometimes you have a little bit of period of time after the plan year that you can incur expenses. And then the health FSA also comes with a contribution limit. So those are some really high-level employer requirements. On the next slide, we sort of talk about some common pitfalls here for Section 125. And the first is just not having any type of plan document. And this is common. This is not the most sort of sought after document or one that employers are most familiar with. Again, we usually talk about that in the context of ERISA plan docs. But having a plan document, sometimes you could work with, if you have an FSA, your FSA administrator may have produced a plan document, which is a good start. But if you want to have a full plan document and you're doing these premium contributions towards medical insurance or dental or vision pre-tax, then you would want to add those benefits into the FSA plan document as well to sort of serve as your overall Section 125 plan document. But that could be a problem, not having a plan document. I mentioned those that are eligible for Section 125. If you're allowing people that are not employees to participate, that can be problematic. So this would be a partner in a partnership or a more than 2% shareholder in an S Corp. And again, think about an LLC. However you're structured as an LLC, you could be taxed as a partnership. So if you're in that situation, allowing those individuals that are not employees to participate can be problematic. Independent contractors, this one is challenging as well. Again, they don't have that employee status. You're not treating them as a W-2 employee generally. And so you should not be allowing them to contribute pre-tax because they don't meet that definition of an employee. That can be a bigger issue too, something to look at. That could be actually something that turns them into an employee. You wanted to treat them as an independent contractor and pay them via 1099. But if you offer their benefits, and particularly if you're allowing them participation in the cafeteria plan or Section 125 plan, that could be enough to turn them into an employee. Making special exceptions is always a little bit problematic. So allowing changes outside of qualifying events is what I'm talking about here. Is sort of setting a precedent for others, first of all, but second of all, it's going against the rules of Section 125, and that means that potentially you could lose that tax qualified status of the plan. We don't see a lot of enforcement here from the IRS on Section 125, and so the risk is low, but that should not be a reason to go just start allowing changes anytime you feel is fit for you. Allowing retroactive changes to elections is another common pitfall that we see. That's generally speaking, you allow changes prospectively rather than retroactively. And so that's another one to keep an eye on there. So with that, I'll throw it back to you, Patrick, to kind of go through our next law, which is COBRA here.
Thanks so much, Chase. Yeah, the next topic we're going to be touching on deals with the Consolidated Omnibus Budget Reconciliation Act, or as the cool kids call it, COBRA. It's the regulation that allows continuation coverage for individuals who have lost coverage due to one of a number of triggering, especially enumerated or specifically enumerated triggering events, the most common of which include the termination of employment, the reduction in hours, divorce, or the death of an employee. It's a regulation that applies to employers with 20 or more employees. It generally does not apply to church and federal government plans, but employees of related employers are included in that 20 or more employee count when it comes to trying to determine whether or not you are subject to the COBRA regulation. As far as employer requirements are concerned with COBRA, employers have to be aware of there are different notice requirements, specifically, at least for this purpose, the COBRA initial and election notice requirement. The employer also has to determine COBRA premiums, and then also make sure that processes are in place to make sure that the right people are getting those right notices at the right time, and that the COBRA coverage is being administered appropriately. With COBRA, there are a couple of common issues that come up, at least we've seen in the course of our work. And these pitfalls include things like the failure to distribute those notices that I touched on earlier. For instance, with the initial notice, which is to be sent to all newly enrolled employees, that is, those employees that are newly enrolled in the plan, should receive an initial notice within 90 days of that coverage start date. It's got to be addressed to both the covered employee as well as that employee's spouse. The notice explains COBRA rights and also obligations under COBRA. For instance, the obligation to notify the plan in the event of a divorce or when a dependent who may be covered by COBRA be ceasing to be a dependent, that sort of thing. So it's really important that that initial notice be sent out at the right time and to the right people. An election notice is also one of those notices that you need to keep an eye on to make sure that gets distributed as well. That goes to the covered employee, the spouse, and the children. It usually is sent out within 44 days of that triggering event. So if, for instance, you have an employee whose employment has been terminated, they need to receive this election notice so that they can have an opportunity to elect COBRA if they so choose to be covered by COBRA. And finally, a couple of other notices that come up every once in a while in COBRA context includes the notice of early termination, which is usually distributed when, for instance, the COBRA coverage will be terminated because the employee fails to pay the premium, for instance. And there's also a notice called the Notice of Unavailability of COBRA Coverage. And this notice provides explanations as to why someone is not entitled to that continuation coverage. For instance, when someone's employment has been terminated due to gross misconduct, is a circumstance under which COBRA coverage would not apply. So instead of giving them election notices, you would give them this notice of unavailability, for instance. The other thing we like to point out in this section is that when it comes to sending out these notices, mailing is usually your best friend here. Electronic delivery is, certainly something that's more and more common these days. But one of the things you want to keep in mind with COBRA is that, when your recipients include employees who have been terminated, they may no longer have access to the email address, for instance, that you normally would communicate with them through. And of course, the spouses, you may not even know the email address of the spouse. And so it's a good idea to go ahead and mail those just to make sure that they get sent out to the right people at the right time. And it's also helpful to send them by mail so that you can keep track of when you sent them out and who has received those notices. The other thing that we see come up every once in a while is whether COBRA is actually being offered on all the appropriate group health plans. For instance, when it comes to those employee assistance plans or EAPs, if those plans are offering any sort of medical care, more than likely it's going to be subject to COBRA coverage. Similarly, with health reimbursement arrangements or HRAs, if someone is losing eligibility for an HRA due to a triggering event like termination of employment, they are also entitled to an offer of COBRA coverage for that HRA. Similarly, with telemedicine programs, if they're providing medical care, then they're also subject to this regulation. So there's a lot of little ins and outs with COBRA, but those are the highlights. It enables employees to continue the coverage that they have enjoyed while an employee, or while they were eligible for that coverage while they were an employee. But there are several different requirements that you have to keep track of, or at least to keep an eye on while you are administering the plan. Most employers, of course, engage a vendor to do most of this work for them, but it is always a good idea to keep in mind some of these requirements and make sure that the vendor is also complying with those requirements on your behalf. So now let's move on to ERISA, one of the smaller, lesser known regulations when it comes to benefit plans, and I'll hand this over to Chase.
Thanks, Patrick. Yeah, ERISA is probably the most common acronym that people know, right? I guess COBRA too, but ERISA and COBRA are kind of the two biggies that we hear the most about. ERISA is a law that was enacted really to try and protect retirement income, and that's the R and the I in ERISA. Employee Retirement Income Security Act is what that stands for, and That's important to know. Again, thinking back to how this impacts us as employees without even thinking really about our roles and what we do for our companies. ERISA is actually a really awesome law for us. And the reason is because it's really meant to help protect. I'm going straight to that second bullet on this slide, protect promised benefits for plan participants and beneficiaries. That's how ERISA really came about, is back in the 60s and 70s, companies were promising retirement benefits so that they could keep employees on board and keep them until they retired. And then, unfortunately, some of these companies were not fully funding those benefits, and meaning these employees would work, 20, 30, 40 years for a company thinking that they're going to have this nice retirement income when they're done, and only to find out that the company was just kidding, right? And so, not cool. That's where part of where ERISA comes in and says, look, company, if you are going to promise benefits, you got to come through on your promises here. And that is how we get a lot of the requirements under ERISA, is so that the company can make sure that they are showing the participants and the government that they are funding their benefits properly, and that they are sort of notifying. That's the other big part here: inform plan participants and beneficiaries of their plan benefits and rights. So really, I think of it as a protection for employees and then information sharing. And those are really the two big keys under ERISA. Information sharing with plan participants. What is the plan? What are the benefits? What do you have to do to qualify for the benefits? And now we're in the health and welfare space, right, where we're talking about medical plan benefits. What are those? And that includes dental and vision and lots of other benefits. But now we're not talking so much about retirement, at least right now, we're not in the sort of retirement plan space. But informing plan participants of what are the benefits, how do they qualify for them, how do they get paid, and then also that information to the government. When we say Fed there, we're talking about the federal government. That's usually the DOL, Department of Labor, that we're talking about, but also the IRS, and in some instances, the Department of Health and Human Services, which is HHS. But the Department of Labor is really the agency, or the federal government agency that enforces ERISA. So all of that is good news for employees. It means when our employers tell us they're going to give us benefits, we can generally count on that, right? And if not, we have recourse. We can file lawsuits. We can sue the plan for benefits. We can take steps to make sure we're getting what we're promised. From the employer perspective, this again comes with these strings attached, and we have another familiar requirement here with a written plan document. This is the one we're usually talking about when we say plan docs. We just talked about the Section 125 plan docs, but this is the more common one, the one that gets a lot more airtime. And the written plan documents can be a carrier policy, as long as there's a lot of information added to the carrier policy, but we sometimes see that as sort of the base. Carrier policy usually it describes benefits, describes what's available and how it will be paid and all that. But there is some ERISA language that needs to be in there, including identifying who is the plan sponsor or who the company is. Some ERISA rights in there, and for example, the right to appeals for adverse benefit determinations or denial of claims. That should all be outlined in the written plan document, and oftentimes the carrier policy does not have some of that information. So that's kind of what we're talking about. You sometimes hear this referred to as a wrap plan doc or a wrap doc. That has a couple of meanings, and it has to do with the second bullet here, which is summary plan descriptions or SPDs. In some instances, you may have a wrap document that wraps, again, think of the carrier policy as your base document, and then you add a couple pages that have the ERISA language and you wrap them together, and that creates a wrap plan document. Another form of that, or that term wrap doc, can be where you bundle benefits together into one single plan. So let's say you had a couple different options with your PPO and maybe a high deductible plan, and then you have a dental and a vision, and all of those are subject to ERISA on their own, but you want to bundle them into one plan. We sometimes refer to that as a wrap plan or a mega wrap plan. And so one reason you would do that is that it's simpler. Now you just have one plan document instead of 4 or 5 or 6. The other reason is you can now file just a single Form 5500. Form 5500 is really the information that you're reporting on your plan to the federal government. The SPD, on the other hand, is really information that's supposed to go to your employees. And so think about those two purposes of ERISA up above: inform plan participants and inform the federal government. That's really what we're doing with the SPD to plan participants and the Form 5500 to the government. So that's kind of the purpose behind those. Let the government know what's happening with the plan. Let the participants understand what's happening with the plan, and then make sure you're following through and providing those benefits. The SMMs there, that stands for Summary of Material Modification. This plays along with that first bullet on the purpose. If you make a change to the plan, it just comes naturally that you need to inform people of that change. And that's what a summary of material modification is. Oftentimes, and I would say in most cases, the changes that occur to plans happen around open enrollment, right? And so you kind of, as a company, build in the changes into your open enrollment materials, your benefit guides, however you're communicating open enrollment. Usually there's a section that says what's new or what's changed. Technically, that can serve as your SMM. It would be best to identify it as such, so that you're saying, hey, look, we know we have this obligation under ERISA. We're already sending you this benefit packet. We're not going to send you a whole new SPD or plan doc. We're just going to let you know what's changed this year. But that's kind of this idea, of letting people know when a change occurs. In some instances where you have a change that occurs outside of open enrollment, you have another requirement that comes into play, the SBC requirement under healthcare reform. That makes it so you have to tell people with 60 days advance notice. So keep that in mind. At a high level, the fiduciary obligation is really the falling under that purpose of protecting promised benefits. Fiduciary is a really fancy legal word we like to throw around to sound smart sometimes. Really all it means is that you have a heightened responsibility. You have more responsibility than the average person because you're in charge of the plan, or you're making decisions for the plan or on behalf of the plan. And so really the fiduciary obligation is make sure you're providing those promised benefits, make sure you're operating the plan in accordance with the plan documents. In other words, don't be making those exceptions that we talked about under Section 125. Follow the plan docs when you're administering the plan. And then make sure any money that you are receiving from employees, particularly if you're setting them aside in a trust or otherwise, make sure that those monies or those what we call plan assets are only being used for the benefit of plan participants and beneficiaries. So this would include things like overcharging employees for their insurance, like not a good idea. Don't be charging more than COBRA allows when you're doing COBRA. Don't be taking employee contributions and instead of forwarding them to the carrier, you take them and decide to spend on new laptops for all the employees. Those types of situations are problematic under ERISA's fiduciary obligations. And as I mentioned, sometimes you have to form a trust, and that just means forming a trust, putting the money in the trust. Some companies do that, particularly in the self-funded context for some of the tax advantages. There are certain trusts that you can form that have tax advantages. We won't go into that, but in some instances, there is a requirement to actually form a trust. So as far as some difficult pitfalls, we see this a lot, just no plan document or SPD. And maybe there's a summary somewhere or an SBC. Maybe those are not with the ERISA plan documents. And again, that wrap document can help address some of these situations, but just knowing where your plan document or your SPD is. One quick note on that, you can have those two combined. You can have a plan document and an SPD combined. That's okay as long as the SPD is distributed to employees when it's supposed to be distributed. Another issue we see is not distributing notices appropriately or improper use of electronic distribution. Employees that don't have electronic access probably should be receiving all of this, an SPD and these notices by mail. And with electronic access, that usually means like a work email or something like that. So that's something to watch, is how are you distributing the notices? How are you communicating with employees? not making documents available upon request. This is something that you need to do if your plan doc is requested. That needs to be distributed, and not handling plan assets. I mentioned that forwarding of payroll deductions promptly and paying from employer general assets. If you're self-funded, that's generally how you want to be structured. Otherwise, you got to have a trust. So that is ERISA. Can be problematic, but let's move on to FMLA and go back to you, Patrick.
Thank you, Chase. FMLA at the federal level is a regulation that provides for job protected leave wherein an eligible employee can take up to 12 work weeks of leave in a 12-month period for instance, for the birth of a son or daughter, or to care for the employee's own serious health condition, or for that employee's spouse, son or daughter, or even parents' serious health condition. This leave is job protected, and most relevant to our discussion today, health benefits are continued while on the leave under the same conditions as if those employees on the leave are still working. Now, of course, when their employee is on this leave and they are enjoying these benefits, they are still expected to pay their share of the premiums to pay for those benefits. And again, I want to stress we're talking about the federal FMLA here. Various states have their own FMLA leave programs. We won't get into those today, but they operate on many very similar lines. But under the federal FMLA, there are several requirements that the employer has to observe in order to make sure that this leave is administered properly. There is an FMLA poster that is required to be posted somewhere where employees can see that. That can be, in the break room or even electronically in the intranet that all employees have access to. And just like COBRA, there are also various notices that have to be distributed to employees who are seeking this leave. And again, there are processes that have to be followed in order for FMLA to be granted to employees who seek it. Now, there are, again, in our experience, there have been several issues and pitfalls that we've seen from time to time when it comes to administering FMLA. The first one that we see, one of the more common ones, is the failure to distribute adequate and timely notices. There are several different notices that should be distributed when an employee rather, is seeking FMLA leave. For instance, there's the eligibility notice and the rights and responsibilities notice, which is a combined notice under most circumstances that has to be provided by the employer within 5 business days of that employer's awareness of the employee's need for leave. So that has to be distributed. And then not providing advance written notice to employees of the terms and conditions under which premiums must be paid if they elect to continue their coverage while absent on FMLA leave. Now, oftentimes when an employee takes FMLA leave, they're taking that leave in conjunction with other leave like sick leave or vacation leave, so that they are continuing to get paid, and then their portion of the premium for their benefits are deducted from that pay, just as if they were still working. However, there are circumstances when the FMLA leave would be unpaid, and even though it's unpaid, they'll still be expected to pay their share of the premiums. So it's a good idea that for the employer to let the employee know in advance how that their shares should be paid. It could be paid, for instance, in advance of the leave. Pretty rare, but it could happen because you don't know necessarily how long you're going to be on leave. Another method is to pay as you go, which is to say they can either pay through their vacation leave, as I mentioned earlier, or they can simply write a check, for instance, to the plan to pay for their share of the premiums. Another method, which is a common method, is just an agreement to make up for their shares of the premiums while on leave when they return from the leave, when they turn to work. This can be a little risky because on occasion, people who go on FMLA leave don't return to work after the end of FMLA leave, so that it can get difficult to recoup some of those some of the premium share that the employer may have, for instance, paid on behalf of the employee while the employee was on that leave, and now they're in a spot trying to get that back from a former employee. So it's always a good idea to make sure that the employer is up front with the employees before they go on the leave as to how those premiums should be paid. Another thing we see is that they don't recognize FMLA obligations apply to all group health plans. That includes vision, dental, health FSA, as well as the medical plan. And it's something that sometimes people, when they associate it with the health benefits, they think of the medical plans and not the other benefits that are offered under the group plans. Also, FMLA people on FMLA leave are entitled to participate in open enrollment as if they were working. So another thing that we see is sometimes employers overlook those FMLA leave recipients when open enrollment comes around. So it's a good idea to make sure that people who are on FMLA leave receive all the same open enrollment materials as those who are actively at work. And finally, not providing COBRA election notices when an employee fails to return from FMLA leave is an issue that we see from time to time. So even if the coverage was dropped at the beginning of the leave or during the leave, for instance, if the employee feels they can't pay or their share of the premiums, they get the opportunity to drop that coverage. But even if they opt to drop the coverage while they're on FMLA leave, they're still entitled to that election notice if they fail to return to work after the leave is exhausted. So next, we're going to get into the ACA and the Healthcare Reform Act. And again, I'll pass it on to Chase.
Yeah, so thanks everybody for the questions in the chat, and we're answering that as we go. And we know this is a lot of information in one webinar. So just remember, we're trying to go high level here and identify the law, what it means, and some common pitfalls that we see. So Affordable Care Act, this is also sometimes referred to as Obamacare, but the Affordable Care Act, or ACA, is generally how we refer to it, and has been around for 13 years now. Kind of crazy. Coming up in a few days, actually, the anniversary. We're nerds. We remember dates like that. But the ACA is meant for a couple of different reasons to be out there for a purpose. But one was to get every U.S. citizen covered under a health insurance plan. And as part of that, we're going to go back to Patrick in a minute to talk about the employer mandate and offering coverage to full-time employees. Another prong of the purpose of the ACA was to establish those health insurance exchanges and to make access to health coverage easier and more affordable through the premium tax credits. And so we'll see how the premium tax credits impact how we're going to hit the employer mandate. And then we also have this attempt to make coverage more affordable and more understandable. So really, the ACA addresses who should pay for healthcare, not necessarily why healthcare costs are so high. This has always kind of been a little bit of a gripe of mine. We're going to talk about transparency and costs at the end here. So we'll talk a little bit about how that's trying to address the costs. But we're really talking about access, who's paying, and trying to make it more affordable, at least for individuals. So the ACA on the next slide is quite a few different rules. We're not going to go through all of these. A lot of these, if you're a fully insured plan, the carrier is going to be handling these. For self-insured, you kind of have to worry about a lot of these, but again, most plans are kind of designed with pre-existing condition exclusion prohibitions, right? We're used to that by now. Preventive care, we had a little bit of a update on that with the Texas court ruling over the last couple of weeks, trying to figure out which services are preventive care, but that general idea that we can go for immunizations and annual checkups, and it's without cost sharing, that's part of the ACA. Waiting periods can't be over 90 days. SBC, those 4-page double-sided notices that go with open enrollment, those are part of our life now. So we won't go through all of these requirements. It will take too long, but on the next slide, we talk a little bit about common pitfalls. I'm getting backwards here. But failing to provide an exchange notice, that's a notice that goes to any new hire, even those that aren't eligible for benefits. That's supposed to go out within 14 days. So check your new hire processes, make sure that notice is in there. retroactively canceling coverage unless there's fraud or misrepresentation. That's what we call the rescission of coverage rule. You can't go retroactive on your cancellations usually unless you have that fraud or misrepresentation. So if you want to cancel coverage for somebody, generally do it prospectively. Otherwise, check to make sure that there's a good reason for that. Not recognizing that FSA or HRA documents need to be amended for over-the-counter drug reimbursements without a prescription. This one's gone back and forth. The ACA actually said you had to have the prescription, and now we're back in the world where you do not have to have the prescription due to another law enacted since the ACA. But that's another helpful one, but one to check to make sure FSA HRA documents allow for that without a prescription. The PCORI fee, this is one part of the ACA that we thought was gone and unfortunately is back until the end of the decade. That's one that comes in for self-insured plans where the employer has to pay, including HRAs. And if you're in the fully insured context, the carrier pays that. But that's a PCOR filing or fee that happens every year that needs to be paid. And then this we talked about before, the 60-day advance notice requirement if a change occurs outside of open enrollment. So those are kind of some big ones that we see or we've heard about a lot lately related to the ACA. But Patrick, I'm going to throw it back to you to talk about the employer mandate because that's always a struggle.
Thanks, Chase. Yeah, the employer mandate part of the ACA is really where the nitty-gritty rubber hits the road kind of thing in the ACA for most of us. And this is really the mandate that requires employers with 50 or more full-time employees to offer those employees minimum essential coverage that is also affordable. Under the ACA, when we talk about full-time, we're defining that as 30 hours of service or more per week, or another way to look at it is 130 hours per month. If an employer fails to offer coverage to that full-time employee, and that full-time employee then goes to the marketplace to obtain coverage and receives a tax credit to help them pay for that coverage, then the employer may be subject to a penalty under the ACA, which is, we usually call it penalty A. One of the things that we suggest that when you're thinking about whether or not you're complying with the employer mandate, instead of asking yourself, do we offer coverage to all full-time employees, consider instead asking, are there any employees who are not offered coverage? If so, then verify that the employee classification falls into a permitted exclusion. There are very limited exceptions to this mandate. So if you find that there are some employees who are not offered coverage, you want to make sure that they fit into one of those exceptions. Now, the mandate, of course, also requires that the coverage be affordable, and that is, it has to be of minimum value, which is an actuarial determination, as well as affordable. And for 2023, that affordability means that the percentage of an employee's income that goes towards paying for the benefits is 9.12%. Now, depending on the safe harbor that's used by the employer, this means that an employee's required premium contribution towards single-only coverage under the group health plan can be no more than 9.12% of either the federal poverty line, an employee's rate of pay, which of course assumes that 130 monthly hours are worked, or the employee's W-2 income. Now, of course, we don't have a whole lot of time to get into the nitty-gritty of those safe harbors, but note that when we're talking about the federal poverty line and the rate of pay safe harbors, those safe harbors allow for forward planning. That is to say, an employer using one of those methods knows that the coverage will be affordable for the year regardless of the number of hours the employee actually works. This is not really true with the W-2 method. The employer will not know if coverage is affordable until after the year ends, which can be problematic in unpredictable times. For instance, a COVID pandemic. So if you are not sure about, if you don't want that unpredictability, then one of the safe harbors should be considered when you're thinking about how to determine whether or not the coverage is affordable. Now, when you report to the government, you need to let them know if you're offering that coverage and that coverage is affordable. And so that's what you're reporting is covered under Internal Revenue Code sections 6055 and 6056. If you're and it depends on whether or not you're a large or a small employer, or if you are self-insured or insured. If you're a small self-insured plan sponsor, then you have to file forms 1094B and 1095B to the IRS. If you're a large self-insured plan sponsor, then you report by combining Form 1094C as well as all sections of Form 1095C. And of course, employees have to be provided with a copy of that Form 1095C. If you're a large fully insured plan sponsor, then you need to file Forms 1094C and 1095C with the IRS, and then provide Form 1095C to employees. Now, forms must be filed electronically or annually with the IRS no later than February the 28th or March 31st if filed electronically of the following year, absent an IRS extension. Employee statements must be provided by January 31st of that year, that following year rather, but those have been automatically extended 30 days beginning in 2022. Now, when it comes to the mandate, some of the pitfalls that we see here is failing to offer coverage to all full-time employees. Sometimes employers may think that because they hire some students or some interns, they are not subject to the mandate, so they don't need to offer them coverage. Well, unfortunately, unless those students or interns if they're working 30 or more hours a week, more than likely they need to be offered coverage. Also, when it comes to determining affordability, one mistake we see is, again, as we have mentioned earlier, is relying on the W-2 safe harbor in unpredictable times. For instance, if the employee is working fewer hours due to the COVID-19 related slowdown and continues to pay the same dollar amount, this can be problematic because it may suddenly become unaffordable to that employee. So the employer, as I mentioned earlier, may want to consider, say, a rate of pay method instead. And finally, one of the pitfalls we see is the failure to properly report those 1095 information forms to the IRS. And because the IRS uses those forms to determine and propose potential penalties. So the employer should verify accuracy to avoid the need to later attempt to explain and correct errors upon the receipt of one of those dreaded 226J letters from the IRS saying that they did not offer affordable coverage to a full-time employee. So now let's move on to another area, HIPAA, and I'll send this back to Chase.
Thanks, Patrick. Yeah, so HIPAA, we've got a kind of two parts to, and really quickly, the portability. This goes back to the original purpose of HIPAA, which had to do with taking coverage from one employer to another, one source to another. So that term portability doesn't really have a whole lot of application, but it's still kind of how we call this part. But there's two big things: the special enrollment rights, which give the right to somebody to enroll in the plan when they have certain events, the most common being loss of group coverage elsewhere, marriage, birth, or adoption. And so those are really important to remember and to make sure they're administered correctly. We have a little bit of an extension of the time frames here coming out of the pandemic, but those should be expiring soon, and we'll be back to the original sort of windows on those enrollment rights. But that's portability. And then the other part is discrimination based on a health status. And this is just that idea that you're not telling individuals or charging them more or impacting their eligibility because of their health claims history, because you know they're sick and they're costing the plan a lot. Those type of decisions need to be kept away from any type of decision relating to the plan. The bigger part of HIPAA really comes in with privacy and security. And this is just that idea that we're protecting our health information of our employees. Again, it's a great thing for us as employees to know our employers can't go out and sell our information, personal information, our health information. But this does come with quite a few, on the next slide, quite a few employer obligations, including developing privacy practices and procedures and security. Again, to delineate those really at a high level. The privacy practices and procedures is all about what the employer can and can't do with the information. Obviously, they can take information from a doctor to process the claim and pay it, and to make sure the plan is running. But the privacy also says you can't, as an employer, go out and sell that information. You can't send it to people that don't need to see it, that kind of thing. Security is all about the electronic form of this, talking about in computers, on email, what's the firewall protection, what's the encryption, what's all that. That gets into the tech world, outside of us lawyer brains, but that's really what security is about. So if you're self-funded, particularly, you really need to focus on privacy practices and procedures and security, and make sure that you are in a good place to protect that information and that you have those policies in place. You also need to provide notices of policy of those practices and procedures to employees. Carriers handle this in the fully insured context, but and there is a model notice for that one. These other HIPAA requirements really come into play if you have a breach. There's some notices that need to go out. Hopefully that doesn't happen, but that's part of what's there. And then business associate agreements are really important. That just allows you to share information with those that are helping with the plan. It kind of ties the vendor or the subcontractor with you to make sure they're following HIPAA as well. So I know, again, we're going pretty fast here. But a couple of challenges, and again, we'll provide these slides. So if we don't get to all of these challenges, if we don't get to every law here, you'll have this as a takeaway. One thing I wanted to say, I already mentioned the self-insured plan. That's where the heightened HIPAA obligation is for privacy. But for wellness programs, HIPAA does have some very special I mean challenging rules about wellness programs, particularly where you are tying a reward to the premium, or some type of HRA contribution, or tying it to the plan in any way. This would be like a tobacco surcharge, something like that. So keep an eye out for those. It's a lot more complicated. We've done other webinars just on that topic, but know that that's out there. HIPAA training is another big one that I would say pay attention to. Again, particularly if you're self-insured, make sure those that are handling this information understand what HIPAA is all about. So those are a couple highlights and challenges that we see in HIPAA. Take it away on Medicare there, Patrick, which is our next big law.
Thank you, Chase. Yeah, Medicare is another area that we'd like to touch on. And the main areas here, it regards the Medicare coordination of benefits with the group health plan. Specifically, Medicare secondary payer prohibitions prevent employers that have 20 or more employees from providing financial or other incentives for Medicare eligible employees not to enroll or terminate coverage in a group health plan that pays primary to Medicare. Also prohibits the plans from taking into account age-based Medicare entitlement of current employees. Those employees should be treated the same as any other employee who is not Medicare eligible. And so your SPDs, when we're talking about, for instance, ERISA documents, your SPD should disclose information regarding when a group health plan pays primary or secondary to Medicare. And I just wanted to mention here that TRICARE has similar prohibitions. In order to make sure that Medicare is paid secondary under most circumstances to the group health plan, there are several disclosures that have to be done, including the Medicare Section 111 reporting, which is to be reported to the CMS on a quarterly basis, and it tells CMS who in the plan may be Medicare eligible and for whom Medicare would be a secondary payer. But in addition to that kind of reporting, another important disclosure that should be reported when it comes to Medicare is the Medicare Part D disclosure form. This basically lets a Medicare eligible individual who would be participating in the group health plan whether or not that plan's prescription drug coverage is creditable, which is information that eligible individual will need in order to make a determination as to whether or not they should enroll in Medicare Part D. Because if they fail to timely enroll in Medicare Part D, those individuals might face higher premiums or hefty penalties from CMS. So it's good for them to know whether or not the coverage they're receiving from the group health plan is creditable. Because if it is, then they can delay enrolling into Medicare Part D. So it's a good idea to make sure that those individuals in the plan that are eligible receive this disclosure prior to October 15th, which is when enrollment in Medicare Part D begins. Some of the pitfalls in this area include not filing those disclosures with CMS and failing to distribute that Part D notice to all eligible individuals. Often plans will just send this Part D notice to everyone, regardless of whether or not they're actually Medicare eligible. But it's a good idea to make sure that that gets to those Medicare individuals at a minimum by October the 15th. So the next area that we should touch on briefly is the non-discrimination area, and I'll pass that back to Chase.
Yeah, so the non-discrimination testing we talked a little bit about up front, but this is just the idea that you're, for the most part, that you're not favoring your highly compensated. If you want to push ahead one more slide, Patrick, yeah, there. Section 105 goes back to self-insured plans. And so we talked about section 125. This slide's really highlighting the difference in the definition of highly compensated and how you call that. 105, again, applies to self-funded plans, including HRAs. And so just a difference to note there in how you're defining your highly comped. So that's kind of a general idea. Then we have a couple other non-discrimination like GINA that just says don't make decisions based on family medical history information or genetic information. And some common pitfalls here are just looking for those disparities in plan design and waiting periods. And excuse me. Yeah, so with that, I mean, tax goes along with non-discrimination as well. And so let's bump it back to you for taxation there, Patrick.
Okay. Since we only have a few minutes left, I just want to touch on a couple of issues in taxation that we see a lot. For instance, when it comes to domestic partner benefits, not all plans offer benefits to domestic partners, but when they do, unless that domestic partner is a tax dependent, any benefit is taxed to the employee through imputed income, so that it's imputed to the employee, and the employee is responsible for paying for those benefits. And when it comes to group term life insurance, it's important to note that the cost of the employer provided coverage for the employee that exceeds $50,000 is included in the employee's gross income for both federal income and payroll tax purposes. And let's touch on some other federal mandates that also come up when it comes in the benefits compliance context. Chase?
Yeah, so we're running right up against time here. I think we've just got about 3 or 4 minutes left, and I think we can get through all of this. But this is just kind of a catch-all for some, I don't want to call them random because I don't want to diminish their value, but Mental Health Parity and Addiction Equity Act. This is just the idea that we're treating mental health benefits on the same, with the same respect as we do for medical and surgical. Medical and substance. Medical and surgical benefits. And so lately, this has been a law for a couple of years now, and but lately we have this new requirement to provide a mental health parity analysis, which means if the DOL asks, you need to prove it. Make sure that you don't have any quantitative limitations and you don't have any non-quantitative limitations in your plan design. So you'll hear about that one. We're waiting for a report to Congress to kind of hear more about what are the problems that the DOL is seeing on this. And that will be good guidance to help know what employers need to be doing. But just that general idea of mental health and substance use disorders being treated on par with medical and surgical. The Newborns and Mothers Protection Act has a sort of protection for minimum hospital stays. There's some language that needs to be in the SPD there with a model notice provided. Qualified medical child support orders. This is just following court orders and making sure you have written procedures to do that. And then on the next slide, a couple more. USERA, which is a continuation for those in the services, uniform services, and WICRA, which is some coverage for medical and surgical mastectomy bits. The biggest one, again, we'll wrap up in about 1 or 2 minutes here because I know we're at the top of the hour. But the CAA is the most recent big law that we're dealing with. It has to do with transparency and coverage, and where we got that mental health parity analysis requirement. This law is really meant to try and help raise awareness about what costs are and to protect people from surprise billing and some other transparency in coverage requirements. And so we have some great resources that go through these that we have a screenshot on in the next, but it just has some random requirements that need to be reviewed, and NFP can help with that if you're one of our clients. Otherwise, we've got some good resources to help you understand this better. So reach out to your contact for those. But a couple of those are the prescription drug data collection that's happening. We're hearing from carriers, and that's coming up here mid-year, and then some other requirements as well. So with that, I know we're a minute or two over. We will share these slides. So I know we went fast, but you'll have that as a resource to go back and look at some of those common pitfalls, any of the other questions that may come up on these. So really appreciate you guys, everybody dialing in. Thank you, Patrick, for joining me on the presentation. It was a pleasure.
Thank you, Chase.
And yeah, I think with that, we throw it back over to Amber to give us our outro, right?
Sounds good. Thank you, Patrick and Chase, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you, everyone, for joining us, and have a great day.